All right, we are live with another edition of Wealthy and Wise Wednesdays, where I share a few words of financial wisdom to help put you back in the driver's seat of your financial future. Thanks for joining me for this week's podcast. All right, there's a lot to be talking about here today, and I can't wait to share this information with you. But first, before we dive into all that, we should just make a note, standard disclaimer. That's what this podcast series is about. It's about information and it's about education. And while I am a personal financial consultant and an investment advisor, what I discuss on these podcasts isn't to be taken or construed as specific or personal financial advice. Rather, it's about providing you, my dear viewer, with information and with resources to empower you with the knowledge so you can make informed decisions that feel right to you. And then if you'd like my assistance in guiding you down that path, that's where I can learn about your specific situation and give you personalized financial advice. So if you'd like to contact me regarding my services, you can direct message me here on any of my social platforms, or you can email me at ronald.sneller@snellerfinancial.com. Now, speaking of providing information, before we get going, let me sneak in a few cheap plugs. Number one is my YouTube channel. I don't promote it very often. I don't know why, but I should. There is a plethora of information and great content that I've created that I put out about investments, about retirement planning, about annuities, life insurance, the economy, banking, and how money works. I talk about the financial matrix. I talk about politics like we're doing today and how that's likely to impact the economy and how it's likely to impact your financial life. You see, I have spent countless hours and tens of thousands of dollars on my education, formal education through the American College of Financial Services and through Kaplan Financial University, as well as these different classes and research and seminars to learn this material that I'm able to provide to you in little bite-sized Scooby snacks, 10 or 20 minutes at a time in these different segments, including real-life client case studies of their cash flow insurance plans, implementing annuities, different investment philosophies, and even recorded retirement planning mini seminars. So go to Sneller Financial on YouTube, subscribe to my channel, and click the notification bell so you are made aware anytime that I upload new content. Also, one last cheap plug is I do have an email newsletter that my clients find quite valuable. I can send you the same weekly financial information that I send to my clients with ideas on saving taxes, increasing after-tax wealth, insurance, and much, much more. My clients really like these financial e-briefs, and I think you would too. So if you want to be added to my e-newsletter, again, just message me on any of my social platforms or email me at ronald.sneller@snellerfinancial.com. Also, we love questions. We love hearing your questions. So you can send your questions or any comments that you have to these same social media addresses or these email sites as well. Okay, before we get into the meat of today's topic, let's get a market update here and give you an update on current events and news. Now, the biggest news of the week was the dramatic miss, a big swing and a miss in expectations of the non-farm payrolls. Consensus expectations were for hiring to come in at roughly 1 million jobs in April. But instead, what was reported was a very disappointing 266,000. That was your actual hiring number for April. Now, after what appeared to be a pretty solid trend in the previous 3 consecutive months, this disappointment caught economists outright by surprise, especially as most states are beginning to relax or outright remove restrictions due to the coronavirus. Obviously, this report resulted in an uptick in the unemployment rate. So that was some surprising news. And then, of course, this week we had the awesome cyber attack or the ransomware hack on the Colonial pipeline. Now, the Colonial pipeline is the largest operator of the nation's largest fuel pipeline network. This caused gasoline shortages, spiking prices, and mass panic throughout much of the country. Now, thankfully, I got an update about 2 hours ago that Colonial will be restarting their fuel pipeline here this evening. That was about 5 p.m. And that is to restore their service to the East Coast. They said that this will be a process. It'll take several days for the fuel delivery supply chain to return to normal. So some markets that are served by Colonial, they may experience or continue to experience intermittent service interruptions during the startup period. So those are two huge things, the jobs report and then the Colonial pipeline. Now, let's get to our market update. The last several days, not looking pretty at all. Today's closing headlines from Yahoo Finance here. Stocks rocked by soaring inflation. Indexes close over 2% lower. Tech stocks have their worst day in nearly 2 months. So the Dow was down nearly 700 points. The S&P 500 down 2.1%, and the NASDAQ down 2.6%. So all three major U.S. stock indexes close sharply lower today, Wednesday, May 12th. This came after the reading on inflation for the previous 12 months, ending in the cycle ending in April. It came in at 4.2%. That is the highest increased rate in 13 years. Reigniting fears that the Federal Reserve may need to dial back its easy money policies earlier than expected. But more on that in a bit. So the trading earlier today on Wednesday, punctuated by heavy selling in technology shares. Dow Jones Industrial Average suffered its biggest one-day percent decline since January 29th, so over 3 months. Now, here's the thing. The recent volatility that we've been experiencing, this serves as a great reminder of why it is so important to remain committed to a long-term plan and to maintain a well-diversified portfolio. When stocks struggle, there are other asset classes that provide more stability and more peace of mind, and we'll end up talking about some of those options here today. Again, flashy news headlines can make it tempting to make knee-jerk decisions, but sticking to a strategy and maintaining a portfolio consistent with your goals and your risk tolerance can lead to smoother returns and to better long-term success. Now, let's get to these inflation numbers here because I posted a graphic a few days ago on social media that caught a lot of attention, had a ton of reshares. So here's the statistics. Gasoline, this is before the pipeline hack, was up 61% in the last year. Steel, up 77% since January. Lumber, up 91% since January. Copper, up 35% since January. Oil, up 32% since January. And used car sales up 10%, nearly 10% since just March. So let's get into the meat of today's discussion. The Federal Reserve's easy monetary policy and the impact that it's having. Look, when the Fed is pumping the economy full of money like this, you're going to get inflation. What else can you expect? I heard a pretty funny, but the example, it drove home the point. It was Peter Schiff. And this is what he said. He said, if the U.S. government was to cut a check for $1 million and send it to every single American, would that make us all millionaires? Well, not really. Would we be able to go out and all of us be able to buy a hot new sports car like a Lamborghini, something like that, or Ferrari? And the answer is no, because they don't have enough of those cars in production. So what's going to end up happening is these car manufacturers, suppliers, auto dealerships, they're all going to raise prices to figure out this new demand because, look, everybody has more money. Now there's more money vying for the same amount of goods. So these auto dealerships, they're going to raise the prices of the Lamborghinis and the Ferraris. They're going to raise them much higher to where that new price point is where consumers are going to part ways with their newly found hard-earned dollars. So it's going to cause increased prices. So even if we all became millionaires overnight, gosh, wouldn't that be great? Even if we all became millionaires overnight in that scenario, it wouldn't mean anything anymore. Now you'd have to be a billionaire to be able to compete and to be able to buy these luxury goods. That's what happens when you add extra money, fake money into the economy, is that naturally prices are going to spike. And that's exactly what we see happening. But the problem is that the prices aren't spiking on things like luxury cars. They're spiking everywhere. Food, oil, gasoline, lumber. It's affecting consumers everywhere. They're feeling the pinch. Here's another example. Last night, I'm driving to pick up my kids, and I'm talking to my accountant, and he was sharing a story with me that his sister and brother-in-law, they have been working on building a home, building their dream home. And they've been kind of like looking at the blueprints and making slight little changes over the last couple of months. But when they were ready to finally go ahead, during just a few months, the price of lumber soared so much that it would cost an additional $60,000 just for the lumber to build their house. And I think right now, instead of moving forward, it sounds like they're just holding steady, because the comment was made, we already overpaid for the land, we can't overpay for the house as well. So that's one example right there. And I have many builder clients. I just stopped over to a client's house yesterday to pick up a check, deposit it into their account. He's a builder. He does heating and cooling. He has told me about the prices of lumber skyrocketing. But another thing is just the materials. He shared a story where he is working with a customer that needs to get a boiler replaced. And so they gave him a bid, and they took the bid to the supplier or the manufacturer. And the customer decided, okay, yes, let's go ahead. Let's do it. Well, during that week that passed, the supplies to install the boiler increased by $300 in a week. Now, thankfully, the bid was good for 30 days. So my client was able to go to the suppliers and the manufacturer and say, hey, you need to honor this price, because that's what it says here on the bid. Doesn't matter that the prices went up $300 over this last week. But that's just crazy to see these kind of spikes in a matter of months, or even in the matter of a week. It's just absolutely crazy. I would not want to be building a house, or probably even buying a house right now in this environment. If you are, I feel sorry for you. So I hope that things go well. Okay. All right. So we had a question come in, and that's really going to lead into the meat and potatoes of today's topic. I'm just going to kind of break the question down, put it in my own words. With all the printing that the Fed is doing, concerns are growing that they're endangering the dollar's status as the world's reserve currency. Could you see this happening? That's the question in a nutshell. Interesting, because the latest billionaire and superstar investor to wave the red flag on this whole thing is Stanley Druckenmiller. He said, and he's quoted as saying, it is more likely than not that within 15 years, the U.S. will lose reserve currency status. So investing magnate and billionaire Stanley Druckenmiller, again, says it's more likely than not within the next 15 years, the U.S. will lose reserve currency status. And I was watching a really interesting interview featuring a woman named Danielle DiMartino Booth. She is a former Fed advisor and Fed insider, and she is the current chief strategist at Quill Intelligence. And she puts it like this: holding interest rates down, buying trillions of dollars of bonds, even though the economy is recovering and that the markets are thriving, this could very well end up threatening the long-term stability of the dollar. She suggests that they are using emergency measures long after the emergency has passed. Why? Well, to effectively bankroll the spending binge by Congress. After all, I've seen the USA Today where they do the case count, or the states with rising cases. That number was 35 to 40 just a couple of months ago. Today, it's 6. So there is no emergency anymore like there was previously. Now, I've also seen in interviews, Harry Dent also strongly suggests, although not outright accuse, but strongly suggests that the government has overblown the COVID crisis in order to turn on the printing presses and get themselves out of the financial mess that they created. Such as the repo crisis that happened recently. It was buried, it was covered up, and most people don't even know about it. But the banks were really hurting during the repo crisis. And I actually do have a good friend named Brandon Perry. We do a lot of podcasts together and things of that nature. He has outright directly accused the U.S. government of doing exactly that, overblowing the coronavirus crisis in order to print their way out of the bubble that was already in the process of popping. I guess, as Rahm Emanuel once said, never waste a good crisis. So the evidence is abundant that the Fed should have long ago stepped away from these emergency types of policies. They have far exceeded what they needed. And that inflation mark that I mentioned earlier, with the cycle ending in April, that 12-month cycle, 4.2%. It's the highest in 13 years. And that takes us back to, the Great Recession, 2008, the onset of the financial crisis. So if the Fed continues to just keep its head in the sand, pumping out $120 billion of quantitative easing every month, as if we were in a depression, if this continues, there probably is every reason to believe that China will continue to play its long-term game, which, make no doubt about it, their intention is to unseat the US dollar as the world's reserve currency. They're not hiding things like this. They've come right out and said that they want to be, or they want to become, the largest economy in the world. Now, could it happen, though? Could the U.S. lose reserve status as the world's currency? Now, if you think back to the previous currency, that would be the British pound sterling. Think back to World War I. With all the debt that they incurred, the British pound sterling began to weaken appreciably. And by World War II, the coup de grace, that's when the dollar rose to prominence. But that weakening of the British pound sterling, that was a 100-year process. It was a cycle, give or take. But that's close to where we're at. If Stanley Druckenmiller is targeting 15 years from now, that puts us in 2035, 2036. That's roughly when World War II started, about 100 years, about a 100-year anniversary right there. And we're already seeing this trend of the loss of confidence in the U.S. dollar. Here's a couple statistics right here. Foreign holdings of U.S. notes and bonds has decreased, falling by $127 billion. That's nearly 2% over the last year. This, according to the U.S. Treasury. And the IMF, the International Monetary Fund, they recently reported that several banks around the globe are reducing their share of U.S. dollar reserves. In the fourth quarter of 2020, the amount of U.S. dollars held by central banks fell to just 59%. That is the lowest number in over 25 years. So, is there any way to right the ship? Well, Danielle DiMartino Booth had some interesting things to say about the Federal Reserve and about their current chairman, Jay Powell. She actually said, and I found this really interesting, she actually said that Jay Powell was probably the most rational and independent thinker that the Fed has seen since Paul Volcker was in the building. Powell did make an attempt at normalizing interest rates, and he made an attempt at strengthening the balance sheet. And what happened when he did that? Well, the stock market and the corporate debt market started to collapse. Now, you may remember, you got to think back about 2.5 years ago. In 2018, what the Federal Reserve did, they increased interest rates 3 times, 3 quarters of 2018. They increased interest rates just 0.25%, 0.25%. And what happened? The market couldn't take it. By the end of 2018, the S&P 500 corrected over 20%. And you may remember it because of the timing. It was the week of Christmas. It was the Christmas crash. And obviously, people don't like that. The current administration, the Trump administration, didn't like it. Congress didn't like it. So what happened? They ended up spending all of 2019 lowering rates back down, basically undoing everything that they did in 2018. But that's how vulnerable the markets are. Just a couple of quarter point bumps trying to get us back up to normal interest rates led to a steep drop. So Powell was rebuked. And then, like I said, in 2019, they spent the entire year undoing what they did in 2018, undoing the previous year's interest rate hikes. So DiMartino Booth points out that this is the problem with Fed policy going forward, inflating the bubbles of these assets, especially the risky assets. And it's the inflation of prices more and more every single day. Like with the housing market, look at the number of people who cannot find affordable housing. Now, the Fed, in theory, they are supposed to make monetary policy in the public interest. At least that's what it says on their website. So really, it's time for some rationale to enter the discussion here. But she actually kind of took a shot at Powell during this interview. She said that, in her opinion, she thinks that he is so traumatized by his thwarted attempts to bring some normalcy to monetary policy that he might just want to coast through these next 8 months and then get out of there. I don't know, maybe. But look, here's the thing. The Fed always tells us everything's okay, not to worry. This inflation, it's just transitory. It's not going to last, and everything's going to be all right. Makes you feel good, doesn't it? Makes me feel warm and fuzzy inside. But is it possible that they're just saying this to pacify sentiment, to pacify the public, to pacify the holders of US dollars? Isn't that a possible motivation to keep everybody calm and to keep people out of the crisis mindset? Peter Schiff made a great point. The Federal Reserve, a large part of their job is public relations. It's to create spin, to create a false sense of confidence. And when I heard him say this, that struck a chord with me because I talk about that all the time. I talk about the financial matrix, which to me, the financial matrix is a combination of the big banks, Wall Street, the Federal Reserve, and the Internal Revenue Service. So those four. And what they do is they work together to create a spin or to create a narrative to get out their message, to influence the way that we think, influence the way that we act. So we'll take actions that will no doubt profit them much more than it will benefit us. So when Peter Schiff said that their main job is controlling the narrative, it's public relations, man, did that ever strike a chord with me? And there was even an interview with one of the previous Fed chairman, Ben Bernanke. Remember him with the helicopter money? Yeah. He said that they would do anything to prevent deflation. He said that if necessary, they would drop money out of helicopters. Now, I want you to think about that for a second. The Fed chairman, whether it's Ben Bernanke, Jerome Powell, the former one was Janet Yellen, these are the people who have their hand on the spigot of the money that you work your life away for. And he's talking about dropping money out of helicopters. And what I thought was really interesting during this interview that I'm referencing, Ben Bernanke, he gets taken to the table by the interviewer. The interviewer basically says, and I can't remember, it was maybe Motley Fool, Yahoo Finance, some podcast, something like that. But by this time, Bernanke was no longer the Fed chairman. Now, what the interviewer did is he played clips of Bernanke speaking in 2005 and 2006, played clips of him saying, everything's great. There's nothing to worry about. There's no bubble in the housing market. This subprime issue is contained. We're not going to have a recession. Those kind of things. Play these clips for him. So he basically calls Bernanke to the table and says, how does it feel to have been so wrong? You were the most influential person on this planet when it comes to money and monetary policy, and you had more information than anybody else on the face of this planet. How could you have messed that up? How does it feel to have been so wrong? And so what Bernanke said to kind of save face is he didn't actually necessarily admit any wrongdoing or that he was wrong. He didn't say like, oh yeah, we just didn't see it coming. That was a big mistake. We made fools of ourselves. Nothing like that. Instead, what he ended up saying, and I have to read the quote to you here. Well, I couldn't actually speak forthrightly and say what I actually thought because I was part of the administration. Let me repeat that. I couldn't speak forthrightly and say what I actually thought because I was part of the administration. He's saying that he had to toe the party line. But here's the thing. The Fed is supposed to be independent. So what he's basically saying is that the Fed chair, whether it was him or Yellen or Jerome Powell, when you hear them speak, they're not actually saying what they think. They're telling you what the party line is, what the administration wants said. And that is, of course, everything's great. In fact, Janet Yellen, she's, I think, Treasury Secretary right now. The other day, she said something about having to raise interest rates. And immediately, the markets reacted negatively to her saying that they were going to have to raise interest rates. So, of course, she walked it right back. That's the thing. And Peter Schiff said this, the Fed chairman, it's just propaganda for the administration. And to them, confidence is very important. They don't want to do anything that's going to reduce confidence. They want to instill confidence, especially if they feel that the average consumer, like the public perception, if confidence is waning, they want to do everything they can to instill confidence, even if that means misleading people. You see, they're never going to say, well, gee, we think there's going to be inflation, or we think there's going to be a recession, or we think that the dollar's going to crash. Because if they were to say anything like that, they'll decrease confidence, they'll spook investors, and they will cause that very thing even sooner. Any warning of a crash could actually cause one. So they're not going to do it. So you have to realize that they're always going to be up there telling you that everything's fine, everything's great, there's a great outlook, even if there's not. And so they don't want to accelerate the onset of the crisis that they see, even when they do see it, by admitting that there is one. They want to postpone it as long as possible. They want to postpone it as long as possible. And one way to do that is to simply act like it's not even a threat. Okay, so let's go back to Ben Bernanke. And I want to share something with you that I find really, really interesting. Again, the Fed chairman is the most influential money person on earth. And he has now, he left his position in 2014, I think it was. But you can look up this kind of stuff online. He has a net worth of well over $3 million. And do you know where he keeps the bulk of his money? Annuities. Yep, his two largest personal investments in his personal portfolio are annuities. He has one fixed annuity and one variable annuity. You can Google it. And actually, I will link an article below. But why would a guy like Ben Bernanke own tax-deferred vehicles like annuities? Does he know something that the typical financial advisor or banker doesn't want you to know? Don't they tell you to put every cent that you have into the stock market and pump more money in, and that over the long run, it's going to be okay? Every single dollar. Now, look, I'm not against the stock market. I am a believer in the growth long-term of the American economy. But if you remember back to 2008, 2009, even into 2007, things are not always okay. So what kind of message does that tell you that a guy like Ben Bernanke, somebody who's made it to the Millionaires Club through his public service, but he's got millions of dollars. What does that say? That his biggest positions are putting his money into annuities and making sure that he protects his principal. That says a lot. That says a lot. But if you consider the mindset, even the rich don't want to risk their hard-earned principal, right? They keep a portion of their money in a position where it's safe and secure, but where it also has some great upside potential. And that's why I believe that owning a fixed indexed annuity should be a part of almost every retirement plan. And that's why I often recommend them to pre-retirees to move a portion of their funds out of their 401k, out of their IRA, out of their riskier assets and into a fixed indexed annuity. Because just by implementing that as a volatility buffer into their portfolio, it increases the efficiency of all their other investments. And it actually allows them to be a little bit more aggressive with their investments than a retiree normally would be able to, because that fixed index annuity is so secure, but it also allows for some pretty good upside potential. Okay, so Bernanke keeps the largest portion of his funds in fixed indexed or a fixed annuity and a variable annuity. Now, how about Danielle DiMartino Booth, who I quoted earlier? Well, DiMartino Booth, and again, I got quotes here. I gotta read them to you. She said there's a lot to be said for holding precious metals. She said they are not called everyday metals, they're called precious metals. And she thinks that it will be even more important to have a larger hedge with precious metals. So when the interviewer asked her to clarify her position, the interviewer said, so that's your recommendation. The best way to protect your portfolio is to overweight precious metals. And DiMartino Booth responded like this: I think being bold in precious metals right now, being bold, I am personally, so I'd be a hypocrite if I said otherwise. So pretty interesting stuff. In fact, Ray Dalio, the legendary hedge fund manager, he's recommended holding 7.5% of one's portfolio in gold. And then, of course, cryptocurrency has been rising in popularity as an alternative to government-backed currency and as a hedge against the manipulations of the money supply. And cryptocurrency has had some pretty amazing capital appreciation potential as well. Although most people that I hear in interviews, guys like Harry Dent, Danielle DiMartino Booth, Peter Schiff, they're not thinking that crypto is going to make it through the next crash very well. They think that crypto is in a bubble and that it's going to crash with traditional stock investments. I guess the jury's out on that one. It remains to be seen. But here's the thing that I will say, what I'm doing, I'll admit that's where a lot of my personal focus has been in the year 2021. Because if you look at Ray Dalio, 7.5% in gold, or you might even make an argument for 10% precious metals, or maybe hold 15% of your investment portfolio in a mix of precious metals and cryptocurrency. Okay. That's what I've been trying to do this year, is add precious metals, some gold ETF, some silver ETF, some physical silver, and cryptocurrency. So, and why is that my focus this year? Because I had very little precious metals and no cryptocurrency before this year. And, I've realized that I do need to build in a little bit of a hedge into my portfolio, even though I'm young. So I kind of look at a fixed index annuity. That is one separate bucket of money. Because the principal cannot go down, you cannot lose principal due to market downturns, I don't consider that an investment. So if I have a retiree or a pre-retiree, let's say they decide to put 40% of their portfolio or 40% of their money into a fixed indexed annuity to generate income, and then they have the remaining 60% of their money, that's what I look at as their portfolio or their investments, okay? So it's different buckets of money once you retire, with each bucket of money designed to achieve a very specific goal. Income versus growth. And it's not an either or scenario, it's a both and scenario. So again, the point of this is not to give you specific financial advice. Don't go run to your financial advisor and say, Ron gave me the advice to do this, this, and this. Again, the purpose of this podcast, the purpose of these discussions or these segments is to provide information about some of the challenges that we face, and not to scare you, but to inform you and hopefully to empower you and to inspire you to take some positive action in creating some buffer assets in your portfolio if you don't have any, right? Or to create a written financial plan if you haven't done so. Again, I'm not necessarily recommending an annuity for you. I'm not necessarily recommending precious metals for you or cryptocurrency for you. But what I am doing is I'm trying to provide you information to get you to wake up or to ask some questions and to talk with a trusted advisor about your concerns and about your goals, and work together to take positive action steps in your financial life. And if you do not have that type of trusted advisor or that type of person in your life, I would love to be that person for you. All you have to do is reach out on my various social platforms or email me at ronald.sneller@snellerfinancial.com. Well, we've kind of come to the end of today's podcast. I've had a lot of fun talking about the Federal Reserve and about their monetary policy. If you know me, you know that I am not a huge fan of the Federal Reserve. I'm not a huge fan of printing money or printing your way out of a crisis. I am about fundamentals, about the laws of supply and demand, and not about fake currency and fake interest rates and fake growth. I think that right now it feels good to everybody. Look, I've enjoyed a bull market the last 12 years, just like everybody else has. I've enjoyed that, but at some point in time, I just worry that the Fed's going to lose control and that it's going to cause some pain. Okay. So anyways, like I said, get a hold of me if you'd like some advice and some guidance at what you can do moving forward to protect yourself from any of the bad things that could potentially happen, but also stay in a position where you could take advantage of when the good things happen. Well, that's today's rant. And as always, thanks for listening.